Our money is broken. I believe that our financial system has a fundamental flaw, and inflation is just one of the negative consequences we're experiencing because of that flaw. Now, I'm not an economist. I'm a professor of computer science. But for a number of years now, I've been trying to understand the financial system from first principles. I've been trying to understand it the way a computer scientist or a mathematician or a physicist might understand a complicated system, from the ground up. And in this video, I want to explain what I've learned. I want to talk about how our financial system got to the point where it had this flaw. I want to talk about the mechanics of our system and what the incentives of banks and other big players in the system are. And I want to talk about how we can go about addressing this flaw. But first, I want to illustrate some pretty negative consequences of our flawed financial system. Let's start with loans. Now, anytime a loan is made, there's a risk. The risk is that the loan will not be repaid. But when banks make loans in our financial system, something really funny is happening, which is that the banks decide to make the loans, but we take on the risk. The risk for the loan is not borne solely by the banks. And when I explain the mechanics of our financial system, I hope you will be convinced that this is true. A second strange feature of our financial system is that somehow a small group of unelected officials, namely the governors of the Federal Reserve, have an unusual amount of power over markets. In recent times, it's been clear that the words and actions of the Fed affect prices across the stock market and many other markets for assets. And I don't think this is natural or necessary. So here are a few examples of headlines that I found from the Wall Street Journal and New York Times that illustrate this. And they all talk about how investing today is all about trying to understand what the Fed is going to do and trying to reduce the unpredictability of the actions and behavior of the Fed. And sometimes it's about just the particular choices of words used by the chair of the Fed during press conferences. And that's really strange. That's really strange. Why should the words of one individual affect the economic prospects of millions of other people? Now, we do have leaders that we elect to make choices that affect all of us. And maybe that's unavoidable. But I believe that this kind of situation is avoidable. It is avoidable. A third negative consequence has to do with how the banking industry is treated when it gets into trouble. To illustrate this, I want to contrast two bailouts that have happened within the last 15 years. The first is a bailout of the banking industry that happened in the late 2000s, and the second is a bailout of the auto industry. Now, when it comes to the banking industry, it was the Fed that acted to carry out this bailout. And this bailout was funded by just creating money out of thin air. And that kind of action has a cost because it devalues all of the money that's out there. It's just very hard to determine exactly what the cost is. The third feature of this bailout is that it was presented as if we have no choice but to carry out the bailout. And I think that's true. I think it's accurate that we have no choice because the consequences of not doing the bailout are really much worse than the costs of actually carrying out the bailout. Here's a former chair of the Fed and current Nobel Prize winner Ben Bernanke talking about the bank bailout.
Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively, and we need to do that because our economy is very weak and inflation is very low. When the economy begins to recover, that'll be the time that we need to unwind those programs, raise interest rates, reduce the money supply, and make sure that we have a recovery that does not involve inflation.
Now, I want to contrast that bailout with the bailout of the auto industry that happened around the same time. This time, it was the president and Congress that were deciding on the bailout. And they carried out the bailout with taxpayer money. So it was very clear what the cost of that bailout would be, or at least much more clear what the cost of the bailout would be. And finally, the bailout was presented as a choice, which meant that the president had the power to negotiate. He was able to dictate terms to the auto industry, and he had the power to walk away. And that's very different from the bank bailout. Here's President Obama talking about the auto bailout.
It's a pillar of our economy that has held up the dreams of millions of our people. Now, we cannot continue to excuse poor decisions. We cannot make the survival of our auto industry dependent on an unending flow of taxpayer dollars. These companies and this industry must ultimately stand on their own, not as wards of the state. And that's why the federal government provided General Motors and Chrysler with emergency loans to prevent their sudden collapse at the end of last year, only on the condition that they would develop plans to restructure. But after careful analysis, we've determined that neither goes far enough to warrant the substantial new investments that these companies are requesting. And so today I'm announcing that my administration will offer GM and Chrysler a limited additional period of time to work with creditors, unions, and other stakeholders to fundamentally restructure in a way that would justify an investment of additional taxpayer dollars.
Now, whether or not you think government should be involved in bailouts, that's a separate question. I would much rather see any bailouts that do happen the way they happen for the auto industry. Elected officials should make the choices. It should be paid for by taxpayer money, and the cost should be clear. And also, we should have the power to walk away. It shouldn't be a given that any industry is guaranteed a bailout. So here's a structure for the rest of my video. I'll start by discussing the mechanics of the current system. And I'll talk about the incentives this gives to various parties in our current system. Then I'll talk about the problems with our current system. And after that, I'll talk about how we might develop a better system that has better incentives and avoids some of the major problems that we have in our current system. And finally, I'll talk about how we can hope to transition from our current system to this better system. So let's start with the current system. So here's a curious fact about money, which is maybe very surprising if you haven't seen this before. If you went out and tried to count how much money there is at banks, you would end up with two different numbers depending on how you carried out the count. If you counted the money that's in bank vaults, you would end up with a number that's about $3 trillion. But if you counted the money that's in bank accounts, you'd end up with a much larger number, about $21 trillion. And that's because there's really two different kinds of money. There's central bank money, which is created by the central bank, or the Fed in the United States. And this is the money that you can touch. It's the money that you get when you go to a bank and withdraw money, or you transact someone sort of hand to hand. And then there's bank account money, which is the money that's in your bank account, and that's created by commercial banks. Okay. If someone goes to a bank and deposits $1 in the bank, then the bank acquires $1 of central bank money and $1 of commercial bank money. At this point, there is no discrepancy between the two kinds of money. But if at some future point someone wants to get a loan, then the bank executes that loan by just creating a bank account for this person and adding commercial bank money to that account. So this creates commercial bank money out of thin air. And now you see that there's a discrepancy between the amount of central bank money at the bank and the amount of commercial bank money at the bank. So the discrepancy between the two forms of money has to do with loans. Okay. Now, you might be tempted to think that this second kind of money, commercial bank money, is not real money, right? But actually, in our system, we've designed it to guarantee that commercial bank money can always be exchanged for central bank money. This is a guarantee provided by the Fed. And that elevates commercial bank money to the same stature as central bank money. Okay, so this money that's just created by banks actually is almost equivalent to central bank money in our system. So let me talk about how that happens. Well, if the banks are very low on central bank money, and someone comes to the bank and demands their money back, well, now the bank is in trouble. In the old days, this might lead to a run on the bank because everyone would panic and demand their money from the bank at the same time. So to solve that problem, we came up with the Fed. And the Fed solves this problem by stepping in to provide a loan to the bank. The Fed is the lender of last resort. So the Fed provides a loan to the commercial bank and charges an interest rate to the commercial bank for this loan. This is the famous Fed funds rate that you may have heard of. The Fed also allows commercial banks to deposit their excess central bank money at the Fed to earn interest at the Fed funds rate. Okay, so the Fed both provides loans to commercial banks and takes deposits from commercial banks. So that's how the Fed interacts with commercial banks. Now, if you think about this, the amount of commercial bank money in the system is determined by the number of outstanding loans that are out there. As the commercial banks make more loans, they create more commercial bank money. And as these loans are repaid, the amount of commercial bank money goes down. Okay. So the discrepancy between the two kinds of money is related to the number of outstanding loans. Now let's look at some actual numbers. So here's a plot of the total commercial bank money that's out there and the total central bank money that's held at banks. And you see that sure enough, these two numbers are quite far apart. And the gap between them sort of seems to be increasing over time. Okay, more and more loans are being made. Now, as I've described the system so far, it seems like commercial banks can just go crazy and create arbitrary amounts of commercial bank money. But we do have some regulations in place to stop that from happening. One example of such a regulation is called a reserve ratio requirement, where we require commercial banks to hold a certain fraction of their commercial bank money in central bank money. Okay, and that prevents the commercial banks from just creating arbitrary amounts of commercial bank money. So the result is that we have a system where the banks are in charge of commercial bank money, which is most of the money that's out there. And at the same time, the Fed can provide incentives for the banks to either increase or decrease the amount of commercial bank money that's out there. If the Fed decreases the Fed funds rate, then this provides incentives for the banks to increase the amount of commercial bank money that's out there, because they pay a smaller penalty when they have to borrow from the Fed, and they're getting less of a reward when they deposit their cash at the Fed. Okay. On the other hand, if the Fed increases the Fed funds rate, this provides incentives for the commercial banks to decrease the amount of commercial bank money that's out there. So the result is kind of no one is completely in charge of the money. Right? There's sort of a tug of war happening between these two institutions about how much money there's out there. A really big flaw with the system is that we really cannot tolerate default. If the bank makes a loan to someone who cannot repay, then that causes a permanent discrepancy between the amount of commercial bank money at the bank and the amount of central bank money at the bank. And if there are many such loans that default at the same time, then that's a real headache for our financial system. It could lead to the financial system seizing up. The banks may not have the ability to create new loans because they're hitting up against the reserve ratio requirement. Now, we could relax the reserve ratio requirement, but then we'd just be allowing banks to create arbitrary amounts of commercial bank money. which could lead to a loss of trust in the currency and to inflation. Okay, so there's no good solution to the problem of default. And the people at the Fed understand this, and the people at the banks understand this too. And that means that the Fed really doesn't want to see defaults happening anywhere. And as soon as there's a sign that there's going to be large-scale default in the financial system, the Fed tries to step in to prevent those defaults from happening before they happen. Because once they happen, we're in a real mess. And I think that's a really twisted system, because the banks are the ones making decisions about what kinds of loans to issue. But then if they get into trouble and there's a whole bunch of default, the Fed steps in and has to clean up the mess. Okay. So it's in my mind, quite a problematic and twisted setup. And moreover, we've had to face the consequences of this bad design a few times. In the great financial crisis of 2008, and again in 2020, at the start of the pandemic, we were faced with the prospect that there would be wide-scale default in the financial system. And the Fed felt that it had to act. So this is the solution the Fed came up with in both of these situations. What they tried to do is simply step in and buy out the problematic loans before they had a default as much as possible. Okay, so that meant that the Fed simply took possession of these bad loans and paid out the commercial banks for these loans. Okay. Now the Fed actually took many other actions as well. They also lowered the Fed funds rate and relaxed regulations. They tried to encourage the financial system to not seize up, because they were afraid that there would be more and more sort of cascading defaults, with each round of defaults leading to even more default in the financial system. Okay. So they bent over backwards trying to avoid these defaults. And in the process, they ended up injecting a massive amount of central bank money into the financial system to try and cover up the mistakes made by banks. Here's a picture of that describes the actions of the Fed over the last 15 years. This is a plot of the total assets held by the Federal Reserves. But another way to think about it is it's a plot of the total amount of central bank money that the Federal Reserve inserted into the financial system over the last 15 years. So you can see around 2008, they injected about $1 trillion into the financial system, and they used this money to buy loans. From 2020 to about now, they've injected about $5 trillion of central bank money to buy loans. Now, it can be hard to understand exactly how big these numbers are. So let's try and compare them to other large numbers. So here's a comparison of the total amount of central bank money injected by the Fed to the total amount of commercial bank money out there and the total amount of central bank money held at banks. And you see that in 2020, the Fed injected about 1/5 of all commercial bank money into the financial system. The amount of money they injected was about 1/7 of the GDP of the United States, which is a very large number. Most of the money that was injected by the Fed was used to buy US government debt, which is called treasuries. And so here's a plot in purple of the total value of the treasuries held by the Fed. Okay, and you can see that it's about $6 trillion today. Okay. The difference between these two numbers, the remaining kind of asset that the Fed holds is mortgages. The Fed also holds a lot of mortgages. But here's a comparison of the treasuries held by the Fed to treasuries held by other major institutions. So here's a plot. In blue, you see here the total value of the treasury market. It's the value of all outstanding US debt, which is about $30 trillion right now. In green, you see a plot of the total value of treasuries held by foreign countries and foreign entities. And that's about $7.4 trillion. And just to understand where that number is coming from, all of the US dollars that leave the US, or most of the US dollars that leave the US, end up in the hands of foreign governments. And those governments use those dollars to buy treasuries, because that's the safest way to invest the US dollars. So this number represents sort of the holdings of US dollars by foreign governments. And the Fed has now reached the point where it holds a comparable number, $6.2 trillion in treasuries. This number is comparable to the total amount held by all foreign countries. So to me, this situation is a cause for great concern. Okay, we have an institution that's run by 10 people, 10 well-meaning people, but they're controlling an amount of money that's comparable to the amount of money that's held by all foreign governments. And we shouldn't be in that situation. That's the recipe for disaster. All right, so how do we get here? How do we get to this point? So here's a very brief history of central banking in the United States. Actually, a really good reference is the website of the Federal Reserve, where they have a web page dedicated to the history of the Federal Reserve, and I think it's really well written. So you should check that out. But prior to 1791, there was no central bank in the United States. And then between 1791 and 1907, there was a period where we started to play around with the concept of a central bank. In 1907, there was a major financial crisis because there was a massive run on the bank. At that point, we didn't have the Fed guarantee on withdrawals. Okay, so there was a massive run on the bank. And this led to Congress creating the Fed. And the solution they came up with was to create the Fed that would guarantee withdrawals. I think they made a big mistake. Okay, the solution sort of patched up the problem of run on the banks, but it just created new problems in other parts of the financial system, and it gave banks and the Fed sort of all the wrong power and incentives. Okay. From 1913 to today, the Fed has repeatedly evolved. And today, the Fed is tasked with two major goals. Those goals are to maintain low unemployment and to maintain inflation at 2%. So currently, we're in the situation where inflation is far above 2%, and the Fed is scrambling to try and bring it back down. And the Fed is also generally tasked with maintaining trust in the US dollar. We cannot tolerate a loss of faith in the US dollar. Okay, so let me move on to talking about the problems in the system that I just described. I'll summarize them again. The first problem is what I talked about right at the start, that when banks make a loan, we all take on the risk. Banks know ahead of time that if there is large-scale, widespread default in the financial system, the Fed will step in to bail the banks out, and it has. It has done this a couple of times already. And banks know that the Fed will do that again in the future. And that gives banks all the wrong incentives when they make loans. The second problem is something I talked about earlier with the headlines, that the Fed is involved in markets. And I don't think this small group of people should be involved in setting prices in the markets in any way. I think that reveals that's a sign of a flawed system. Here are a couple of phrases that capture this. These are well-known phrases in finance. There's the phrase "don't fight the Fed," which is part of the lingo. That means don't invest in conflict with the Fed. It's generally a good thing to do. And there's also the idea of the Fed put, which is the belief that the Fed will step in to bail out markets. Okay, so somehow, because you have the Fed, this is one of the biggest players in that entire system that's messing around in financial markets, the rest of us are left with the task of trying to guess at what the Fed will do to understand how to invest in financial markets. I don't think that's a good setup. And really, it all boils down to it's just unclear who is in charge of the money. Right? Yeah. The most natural thing to do would be to have the Fed be in charge of money, but that is not how it works at all. Banks have the ability to create new money, and the Fed is on the hook to cover up their mistakes. And at the same time, the actions of the Fed lead to wild swings in markets. And the Fed is constantly watching markets and trying to react to what markets are doing as well. So this has left us with a really jumpy Fed that's trying to predict where markets are going and trying to put out fires all the time. And markets in turn are trying to guess at what the Fed is doing, So it's just a mess. And we need to clean up this mess. So what is the role of the Fed in our current system? Part of the problem is that the Fed has too many things to achieve at the same time, and it's given, I think, too much responsibility. It's trying to maintain trust in the currency. Okay, this seems like a goal that should always be part of the Fed's mandate. It's trying to manage unemployment. It's trying to manage interest rates. It's trying to keep banks solvent, prevent run on the banks. And it's trying to do all of these things at the same time. I think that's too many goals for this one institution. Next, let me turn to the design of a better system. So here are some broad goals that I think we should have for a better system. A core goal would be that there's just one entity in charge of the money supply, and that entity should be the Fed. No one else should have any say in how much money there is in the system. At the same time, we'd like the supply of money to be elastic. The amount of money that's out there should respond to conditions, economic conditions in the world, in a dynamic way. Okay, and sort of those two seem to be in conflict at first. The first two seem to be in conflict, and I think we've arrived at the current system in part to try and provide the second feature. By having the banks decide how much money there will be in the process of creating loans, we are trying to allow the money supply to shrink and grow based on the demand for money. We'd also like the risk for loans to be allocated correctly, right? The people that are making decisions for loans should be the ones that are accountable for the risk. And we really should not be guaranteeing bailouts. We should not be guaranteeing bailouts to any entity and not to the banks. At the same time, we don't want to have panics and we don't want to have any runs on the bank. So these are many goals. Many of them seem to be in conflict with each other. And it seems very difficult to resolve all of them at the same time. But I'm going to try and propose a system that I believe gets the core goals right. Achieves at least some of the core goals at the same time. The first feature of the system I want to design is that there will be only one kind of money. Okay, this is just much simpler and much cleaner. So banks will just hold central bank money in their vaults, and there will always be a correspondence between the amount of money in bank accounts and the amount of money that's held by the banks. So this means that if someone wants to borrow money, wants their money back from the bank, then there's never a problem. There's never a problem with withdrawals, because the bank always has enough money to repay people that have their money in the bank account. Now, what happens if there's a loan? This is, one of the core reasons we had two kinds of money in the first place. So in this new system, I want to fund loans in a different way. Rather than funding them sort of out of thin air, I want to require banks to first raise money to support their lending activity. So when the bank wants to begin lending, it will first go out and sell a bank bond. This is a contract like this that says it's a contract that's worth, say, $100 at some point in the future. And the bank can go out and sell this contract in the open market to investors. So investors will show up and bid for this contract, and the bank will just simply sell the contract to the highest bidder. And at this point, the bank now has excess central bank money. It has central bank money that exceeds the total amount of money that it owes in bank accounts. And at the same time, it owes at some future date money to an investor that invested in the bank bond. So the bank bond basically executes a loan. The bank has borrowed money from investors. Now the bank has enough money to carry out the loan, so the bank will issue a loan. And when the loan is repaid, the bank will use the proceeds to pay back the bond. Okay, so that's how the entire system works. Now the numbers of these sales will be set up in such a way that the interest paid by the borrower here will be allocated to both the bank and the investor in the original bond. Okay, and all of that can be determined by market forces. Now, if the borrower does not have the ability to repay the loan, if there's a default, then it's the investor in the bank bond and the bank that take on that loss. The bank will have to tell the investor in the bank bond that the bank cannot cover the terms of the bond. So the bank will have to default on its debt. When it does that, it will lose reputation. In the future, people will be less willing to lend money to the bank for these bank bonds. And so this will cost the bank in its business. And it will also cost the person that put up the money for the bank bond in the first place. Okay, so those are the people that take on the loss. But the rest of us are not on the hook for the loss associated with that default. Okay, that's a key feature of the system. All right, so that's how I think loans should work. And maybe the first thing you would ask is, can such a system scale up to support the kinds of loans, the magnitude of loans that we are used to? And I think it's clear that the answer is yes, because we are already using exactly the same system, the system of bonds, to fund loans for many other major entities in our financial system. Bonds are how the US government funds its debt, and they're how corporations borrow money from investors. And if you look at the total scale, the total size of the bond market today, it's about $53 trillion, which is much larger than the total amount of commercial bank money that's out there. So what I'm proposing is simply to fold the funding of bank loans into this existing system, which is already operating on a very large scale. And I don't think there will be any trouble in absorbing the $21 trillion of commercial bank money into this market. There's still something a little bit unpleasant about the solution I've described so far, because it doesn't provide a way for the central bank money in the system the supply of central bank money to go up or down. Right? In our old system, commercial banks were in charge of doing the work of deciding when to increase the money supply. And that maybe seems troublesome in this new setup. But I think there are other mechanisms we can employ to regulate the supply of money, and even do it using a market. Okay. And to explain one approach for this, I want to talk about the risk-free rate of interest. Now, this is a term that's often used in finance, but I'm going to use it in a slightly different way. So what is the risk-free rate of interest? Let's imagine that the Fed itself sells bonds. It sells a Fed bond. Now, the Fed does not need to borrow money. The Fed can create its own money. All right. So the Fed doesn't actually need money, but I want to imagine a world where the Fed is actually selling these bonds because the prices of the bonds will be an important financial instrument. Okay. So let's say the Fed sells a bond. Then, as before, investors will line up to buy this bond, and the Fed can sell these bonds at auction. So there's some price at which investors will buy this bond. And let's define the quantity rate of T. This is the interest rate at which the market is willing to lend to the Fed. Okay, so the price at which this bond is purchased gives an implied interest rate at which the market is willing to lend to the Fed, and that's the quantity rate of T. This is a very interesting quantity. First of all, it's well defined even if the Fed is not selling bonds at a particular point in time, because you can imagine a world where these bonds are trading in the open market. So every one of these bonds has a price, and those prices imply an interest rate. Okay, so at any point, the quantity rate of T is well defined. Secondly, these bonds are free of risk because the Fed is able to create its own money. So there's no reason for the Fed to ever default on one of these bonds. Okay, so the Fed will never default. And that means that this interest rate captures something about the cost of renting money. Okay, that's what it captures. And it's a number that's determined by the market. And I think this number can be extremely useful to try to use as a signal for when the supply of money should go up and when it should go down. And the Fed can also use these instruments, these Fed bonds, as a mechanism to either inject money into the financial system or drain money from the financial system. For example, if the Fed wants to drain excess money from the financial system, then the Fed can simply sell a whole bunch of Fed bonds. And this will have the effect of taking money out of the financial system. If the Fed wants to inject money into the financial system, it can buy outstanding Fed bonds. This has the effect of injecting money into the financial system. Now you might ask, how can the Fed buy bonds if nobody is holding a Fed bond to begin with? Well, that can also be handled, because maybe it's a little more technical, but you can still use Fed bonds to inject money by selling bonds that, say, mature in some amount of time, say 2 weeks, and buying back those bonds after 1 week. And if the Fed does this at market rates, or and bids for the bonds at a higher price, then it will have the effect of injecting money into the financial system, and market participants will be incentivized to take part in this process. So these instruments can be used to both inject and drain money from the financial system. Now here's a simple example of a very simple system that can dynamically regulate the amount of money that's out there. So let's say the Fed enforced a rule that it would act in a way, it would buy and sell Fed bonds to ensure that the interest rate of the bonds for some fixed amount of time, say 1 week, is set at 2%. In other words, if the rate deviated from this number, the Fed would either buy or sell bonds to push the rate back towards this number. This basically either injects or drains money from the financial system based on the cost of renting money. If there is very high demand for money and the cost of renting money goes up, then the Fed will be injecting money as a consequence of this rule. And if the demand for money drops and the cost of renting money goes down, then the Fed will be draining money from the financial system. So in this way, we can have an elastic supply of money without having a small group of people making decisions in a complicated way about whether money should come in or not. Okay, and also without giving up control to entities like banks. Okay, that's the advantage of the ideas that I'm presenting here. All right, so that's an example for how to get started on designing a better financial system. Now, there are lots of details involved in getting that right. Okay, I've just thought about the basic setup, and I think the basic setup I presented here gets the core goals right. But there are a lot of details, and making those changes would be a major change. It would be a change to the heart of the financial system. Okay, so no one would be able to predict with complete confidence exactly how that system would operate. But I think it would be starting at a much better point. It would get the first steps right. Okay, so that's a setup that doesn't exist yet. How can we get there? How can we get there given that we already have our current financial system, which looks quite different? I actually think it's not going to be that hard. And let me propose how we can transition from the current system to the new system. So here's the idea. All we need to do is wait for the next time there's a major financial crisis and a whole lot of loans are about to default. And when that happens, banks will want a bailout, as usual. Okay. And so now we're in the current system, so the banks have two kinds of money, and they have a bunch of loans that are about to go into default. At this point, we should have the Fed make a different kind of deal with the banks than the deal is made before. Instead of the Fed just taking over the bad loans that the banks have on their books, the Fed should take over all loans. He should take over all loans. And if it does this, when it buys all outstanding loans, it will inject enough money into the banks to make the commercial bank money equal to the central bank money at the banks. And at that point, we should just merge the two kinds of money and eliminate commercial bank money. From this point on, there's only one kind of money, and banks will need to raise central bank money in order to issue new loans. So I think we should just have the Fed carry out one massive bailout to end all future bailouts. The Fed will tell the banks that we're going to bail you out, but this is the last time. From this point on, you're losing your ability to create commercial bank money, and you're also losing your guarantee for future bailouts. So that's a clean way to rip off the Band-Aid and move to a better world where we just have one kind of money. All right, so to summarize, I hope you've learned from this video how our financial system is broken. And I think the flaw in the system is at the heart of the system. And the only way to fix it is to do open heart surgery. It would require a major change, but I think it's possible to execute that change. We've done it before. We've made changes that were that big before. We just need political will and the right kinds of leaders.